Good afternoon, boys and girls. It's the Liberty Call for Tuesday, January 18th, 2022. I hope everybody's having a great day out there in the interwebs. It's kind of an overcast and gray day here. It's not too cold. We're pushing up towards 50 degrees, but the next couple of days, I think the high tomorrow is only 28. And we'll get a couple inches of snow, and it's going to be cold most of the week until the weekend. So right when my wife gets back on Sunday, so it'll warm up by then. So she'll be pleased because she's not a fan of the cold weather, being a good Florida girl. So, all right. Like I said, hope everyone's having a great day out there. If it's your first time watching, be sure to smash that subscribe button. Also, like and share with friends, or like the video and then share it with friends and family. I would greatly appreciate it. Let's go ahead and dive in to see how the markets did today. As noted, the market was closed yesterday for MLK. So this is the first trading day of the week. All right. The Dow Jones was down 1.51% today, closing at 35,368. The S&P 500 was down 1.83, closing at 4577. NASDAQ closed down 2.6% at 14,506. Small caps are also down 3.2%. The VIX shot up 18.76% today to close at 2279. So if you've been paying attention to the VIX the last few weeks, it's gone up, it's gone down. It did go over 30. When was that? Probably early January, maybe late December. So, for me, 30 is kind of my, number that I look at is, all right, stuff's getting bad. We need to, take evasive action. But until we get up to that number, I really wouldn't worry. Anything under 20, I view as, no one's really even concerned at all. So we'll see where that goes over the next couple of weeks. Lots of red across Europe. The only green I see is the Bovespa. Let's see here. Red. Same thing. Well, no. Down in or on the other side of the globe, over in Asia, we had mostly green other than the Hang Seng. The Shanghai was up 0.8. The SZSE component was up 0.19. The China A50 was up 0.99. And the DJ Shanghai was up 0.82. So it looks like Asia was the only bright spot for this trading day. But, hey, it's not the end of the world. All right. I have a couple articles I want to cover with you guys. The first one is oil hits 7-year highs as Mideast unrest stokes more supply jitters. This came out about an hour ago. Was written by Stephanie Kelly at Reuters. All right. So let's go ahead and breeze through this real quick. Hey, I got somebody online. Cool. All right. Oil prices on Tuesday climbed to their highest since 2014 as investors worried about possible supply disruptions after attacks in the Middle East added to an already tight outlook. Brent crude rose $1.03 to or 1.2% to settle at $87.51 a barrel. WTI futures rose $1.61 or 1.9% to settle at $85.43 a barrel. Both benchmarks touched their highest since October of 2014. Supply concerns mounted this week after Yemen's Houthi group attacked the United Arab Emirates, escalating hostilities between the Iran-aligned group and the Saudi Arab-led coalition. After launching drone and missile strikes that set off explosions in fuel trucks and killed 3 people, the Houthi movement warned it could target more facilities, while the UAE said it reserved the right to respond to these terrorist attacks. Strike on a leading Gulf Arab ally of the United States takes the war between the Houthi group and the Saudi-led coalition to a new level and may hinder efforts to contain regional tensions as Washington and Tehran work to rescue a nuclear deal. The damages to the UAE facilities in Abu Dhabi is not significant in itself, but it raises the question of even more supply disruptions in the region in 2022, said Rystad Energy's oil markets analyst Louise Dixon. The attack raises the geopolitical risk in the region and may signal the Iran-U.S. nuclear deal is off the table for the foreseeable future, meaning Iranian oil barrels are off the market, boosting demand for similar grade crude originating elsewhere, Dixon added. UAE oil company ADNOC said it had activated business continuity plans to ensure uninterrupted supply of products to its local and international customers after an incident at its Musafa fuel depot. Also adding to geopolitical price premiums are rising tensions between Ukraine and OPEC Plus member Russia. Supply concerns have been brewing as some producers within the organization, bless you, Jake, are struggling to pump up their allowed capacities under OPEC Plus agreement with Russia and allies to add 400,000 barrels per day each month. OPEC on Tuesday struck its forecast for robust growth in world oil demand in 2022, despite Omicron virus variant and expected interest rate hikes, predicting the oil market would remain well supported through the year. The United States output in the Permian, the largest U.S. shale basin, will surge to record in February, according to a monthly forecast from the U.S. Energy Information Administration on Tuesday. Goldman Sachs analysts said they expect oil inventories in the OECD countries to fall to their lowest since 2000 by summer, with Brent oil supplies rising to $100 later this year. So there's a lot in this article to kind of break down. I mean, number one, oil prices are going up. I don't think anyone is, delusional to that fact that the price of oil, in their estimation, is going to go over $100 a barrel again. It sucks that there's this conflict in the Middle East, regarding what's going on in Yemen. I mean, it is to me, it's a what's the word I want to use? It's just it's a humanitarian disaster. I mean, the U.S. is on the side of the Saudis, which are committing a genocide against the Yemeni people. I'm very opposed to any sort of force used against peaceful people, and the U.S. government aiding in starvation of women and children. I have a real problem with. And I have a real problem with my tax dollars going to fund these programs. So it is unfortunate, and it's even worse that it is affecting the price of energy here in the States. So, anyways, all right. Next article. Let's go ahead and add that back. BlackRock's Fink sees flattening yield curve amid bond tantrum echoes. Who is this written by? David Barbusia. This is from Reuters. A fast pace of monetary policy readjustment to curb inflation could lead to a flattening of the U.S. Treasury's yield curve, warned BlackRock chief Larry Fink, amid a recent spike in yields that some said echoes of 2013 taper tantrum. The shape of the yield curve reveals investors' expectations for U.S. growth and monetary policy. A hawkish stance by the Federal Reserve, planning sooner than expected rate increases, has pushed up short-term rates, flattening the curve. I think the yield curve is going to be flattening. I can even see if the Federal Reserve is very aggressive. I can see a negative yield curve. Fink told CNBC in an interview on Tuesday, according to a transcript. Wow, that's a very eloquent statement. Glad to know that billionaires are as poorly spoken as I am. A negatively sloped or inverted curve is a phenomenon that is considered bad news for short-term economic outlook and has presaged past recessions. The shape of the yield curve is going to be a critical issue that's going to determine the economy, Fink said. The chief executive of BlackRock, the world's oversees $10 trillion. Added he expects inflation to be higher and the Federal Reserve to be aggressive for the next 2 years. Fink's remarks followed some Fed speakers, such as Kansas City Fed President Esther George, who last week urged a swifter runoff of the Fed's balance sheet than in the last tightening cycle due to risk of flattening the yield curve if rates are raised while the balance sheet is swollen. Financial markets are expecting that the U.S. Federal Reserve could raise rates as many as 4 times this year after post-pandemic stimulus measures that boosted the U.S. economy, but also caused inflation to rise. On Tuesday, 2 U.S. Treasury yields, which track short-term interest rate expectations, rose above 1% for the first time since the start of the pandemic, further eroding the yield advantage longer-dated securities usually hold hold over shorter dated ones. The yield curve between 2 and 10-year notes earlier flattened to 81 basis points, the smallest yield gap since January 3rd. Bond tantrum. The yield spike had some echoes of the 2013 taper tantrum. BlackRock Investment Institute said in a research note on Tuesday. At that time, bond yields jumped after then Fed Chairman Ben Bernanke signaled the start of the unwinding of the Fed's bond purchase program and sparked the taper tantrum. Yet we see key differences. It's not driven by fears of a sharp increase in the policy rate. Growth is strong, and the Fed is honed its signaling, it said. Thomas Matthews, an economist at Capital Economist, told Reuters, similar to the 2013 taper tantrum, the recent spikes in yields was linked to the rate hike implications of the Fed's hawkish pivot, but also pointed to distinctions. The rise in yields over the past couple of months has still been quite a bit smaller than we saw back then. And while we have seen some wobbles, we haven't seen the big sell-offs in risk assets, especially those in emerging markets, that characterized that episode. He said, not everyone sees a flatter curve. U.S. investments firm PIMCO said last week it's looking to position portfolios for a steeper curve in expectation of more normal economic conditions. So, like I've said, these people who seem shocked that we would have this sort of inflation over the last, really over the last year, and are just completely dumbfounded that, creating $4 trillion was going to have a negative effect on us long term. It's puzzling, shocking even. All right. Last article comes from First Trust, Brian Westbury, their chief economist. It's titled, Who Gets the Blame for Inflation? Thought this was apropos for the other articles we're talking about. Consumer prices rose 7% in 2021, the largest increase for any calendar year since 1981. As a result, politicians across the political spectrum are working overtime to find someone to blame and attack. Well, look at yourselves, dumbasses. Some politicians on the left are blaming greedy businesses for inflation, but we find this explanation completely ridiculous. Of course, businesses are greedy in the sense that they're run by people who are free to maximize their earnings. But businesses are no greedier today than they were before COVID. In the 10 years before COVID, the consumer price index increased at a 1.8 annual rate. In the 20 years before COVID, the CPI rose at a 2.1 annual rate. Both figures are a far cry from 7%. Blaming greedy businesses for higher inflation have no rational explanation for why businesses somehow missed all the opportunities to raise prices faster in previous decades, but suddenly had a eureka moment and decided to do so in 2021. Under this economically illiterate theory, Ms. Warren, think of all the profits they voluntarily forgone for decades. Meanwhile, think about the rapid increase in worker pay in 2021 when average hourly earnings rose 4.7%. Did workers suddenly become greedier too? Is all this greed contagious? Can we stop it by wearing masks? I doubt it. What does the CDC have to say? But the political left is not alone in misunderstanding higher inflation. Some politicians on the right are saying inflation is due to the huge surge in COVID-related government spending and budget deficits. Part of this is likely tactical. By blaming government spending and deficits, they can reduce the odds of passing the Biden administration's Build Back Better proposal, which they like to see defeated. What they're missing is that there's no consistent historical relationship between higher spending and larger deficits and more inflation. Yes, inflation grew in the late 1960s after the introduction of the Great Society programs, but government spending also soared in the 1930s under Roosevelt's New Deal without a surge in inflation. Budget deficits soared in the early 1980s and inflation fell. The panic of 2008 led to a surge in government spending and deficits and inflation were maintained. I'd say that's debatable. Things got more expensive. So if it's not greed or government spending by itself, then what's causing higher inflation? We think it's loose monetary policy. The M2 measure of money supply has soared since COVID started. This is the not so secret policy ingredient that has converted extra government spending and deficits into more inflation rather than higher interest rates. That in turn makes it important to follow a path of monetary policy this year and beyond. In recent weeks, a number of Fed policymakers have hinted at a rate hike starting in March, including Mary Daly, the president of the San Francisco Fed, and considered a dove. Rule of thumb, when the doves get hawkish and start hinting at rate hikes, it's time to believe the hints. I believe that's true. The futures market in federal funds is pricing in 4 rate hikes this year. For now, we think it's most likely policy path is 3 hikes, 25 basis points each in March, June, and December, with a hiatus for the midterm election season. Yeah, you wouldn't want to gin up that too much. In addition, we think the Fed finishes up quantitative easing in March and starts quantitative tightening around mid-year. The easiest and most straightforward way for the Fed to do QT, which would be by selling off Treasury and mortgage-backed securities to the banks and having the banks buy them and send their reserves back to the Fed. The Fed can erase those reserves from its balance sheets. That would result in the Fed holding fewer bonds as assets while being liable for fewer reserves reaching its overall balance sheet. Instead, the Fed will probably take a more complicated path by not rolling over some assets when they mature, which means the Fed will have to coordinate its operations with the Treasury Department. The key to remember, though, is that a few rate hikes and some modest QT will still leave monetary policy too loose, while actual short rates remain well below the trend in nominal GDP growth. The Fed has its work cut out for it. Its goal to execute a reduction in inflation while sticking a soft landing for the economy. A year from now, we'll have a much better idea whether it can meet both of these goals. All right. So, like I said, it's they're going to have to land a 747 on an aircraft carrier, and I don't know if they're going to be able to do it, quite honestly. So, we were already dealing with their mistakes of creating all the dollars, and we're also dealing with no one wants to look bad, quite honestly, and that's kind of how I look at it. Those in Washington don't want to take the blame for trying to keep the economy afloat, and those in the administrations or administrative functions want to push the blame off onto the politicians. So anyways, all right, well, that's everything I had for today. If anyone needs anything from me, don't hesitate to shoot me an email or drop me a phone call, and I'll be back tomorrow with the Liberty Call for Wednesday. Hope everyone has a fantastic evening. Bye-bye.